will be neutral for some time into 2014 or maybe even to 2015. There's no real signs of inflation yet in the United States and the Eurozone. And really, the potential of the US economy is much greater than output. There's need for having about 8 million jobs still before we return to the pre-crisis mode. And it will take many, many years for jobs to come back. And also, the US economy tends to be recovering slowly, and tends to be percolating along. And as the economy recovers, the central bankers, it's believed, could remove the excess liquidity by reducing balance sheets of the, or in some sense, just forgiving the debts of the government that are held on the books of the central banks. Obviously, a lot of us worry this is completely new policy that's never been done before in the world, or the US for that matter, increasing money and increasing the balance sheet and the money printing that has occurred in the US at this rate. And when I read a lot of different pundits, a lot of people that have very skeptical views, they're very worried this will work until it doesn't. Okay? When it doesn't, then we'll have massive amounts of inflation. And can the government hedge inflation? Can the government act to stop inflation once it takes over? And we had that happen in the 70s in the United States. We had vast amounts of inflation that were uncontrolled. So a lot of the view is the stock market increasing, or the wealth effect increasing as the government thinks it's increasing, namely that people are buying stocks because the government is keeping interest rates low, or is people buying stocks to hedge against unanticipated inflation? If you buy bonds, you can hedge your risks of anticipated inflation, but the only way you can hedge against a shock in inflation, an unanticipated jump in inflation, is to buy real assets such as stocks or commodities or homes and things like that that'll hedge you against unanticipated inflation. So in the bond market, the short end of the bond market, protects you against things you anticipate, because the interest rates today incorporate anticipations. But the unanticipated component, all of a sudden a shock occurs, you have to buy real assets to protect yourself against the unanticipated inflation. And somewhat we see at the longer end of the US curve, maybe the market's telling us something, but interest rates have gone up quite considerably in the last period of time. And market participants might be getting to become worried about these very aggressive policies that are being put into place by the Federal Reserve. So I went backwards. Sorry about that. And the European Central Bank is now providing liquidity as well. And their balance sheet is amazing, $3.6 trillion, smaller economy than the US. And Japan is also having a very aggressive policy, signaling more accommodation. And Kurudo-san, who applies the big bazooka, as it's called in the vernacular, and is that, so the second arrow of Abe-san, the prime minister's plan to have massive financial stimulation, monetary stimulation, printing of yen, to be very aggressive, to stimulate inflation, to depreciate the yen, and to encourage exports and investments abroad. There's about $17 trillion of savings in Japan, and the idea is trying to motivate the savings which are in cash accounts. Obviously, because of deflation, the return is very high, and encourage investors to invest abroad. And we see that emerging market rates and investment returns are very much a function of, as the yen depreciates, more money is moving out. As the yen appreciates, more money is coming in. And the People's Bank of China has also increased its reserves dramatically since the crisis of 2008, $1.5 trillion of reserves. And it's interesting that they're very worried in China about the increase in credit and the inflation that's occurring in China itself. And so the growth of credit has been a concern. It's been quite dramatic and is trying to be curtailed. So the West, in terms of Europe, the United States, and Asia, in terms of Japan, are really trying, in Europe and the United States are really having in a summary, aggressive monetary policy, but at the same time, very conservative fiscal policy, government spending and fiscal policy, while in China, the reverse tends to be true. And now Japan had a very aggressive fiscal policy, a large fiscal stimulus at the same time as they had a very tight monetary policy. And now Japan is moving to a very accommodative fiscal policy and a very accommodative monetary policy as well. So these are all new experiments, and taking the top-down approach, which is making it very difficult for investments and investors in the economy to really know what's going to happen or the direction of the economies going forward. So I think the second, as I said, fiscal policies are working. But the economy is going along at a tepid rate. What we had is the economy before 2008 in the United States was growing at about 2.5% a year, and then we had a shock which pulled it down by about 7% or so, and it's growing at the same growth rate that it had prior to the shock. So we didn't have this recovery, and that's what the government and the Federal Reserve is trying to figure out how to do. So I think that and I think that basically in terms of fiscal policies, things are very slow. Things are not growing around the world in an aggressive way. We don't have the next new thing. I know that all of you who are students are thinking that the great growth of the internet is wonderful and sort of VCheck or other types of things, but that's not really creating a lot of jobs. And Google only has 30,000 people working for it, so it's not going to be a very big employer in the future. So basically, reversion to a normal cycle. We come back slowly, less so than a typical recovery, but maybe this is the new normal, as others have argued. So we're going to have a point here of trying to have reflation, okay, and fiscal rebalancing in the West is sort of our new macro. We've had increases in taxes in the United States, and we have sequestering, which is reducing government expenditures. And Congress, as you know, in the United States tends to be deadlocked into what we should do with regard to our fiscal policies. So I think that in China's fiscal policies, I don't think the economy is going to accelerate sharply, and I don't think that you're going to also have slow liberalization of the financial system. And I know that there's a worry about the possibilities of having bubbles in the housing market itself. So I think the growth will be lower, actually, in my view, than the 7.5% current view. And I don't mind that for China, because the growth in GDP in China or other parts of the world can be good growth and bad growth. You can always grow GDP by investing in bad projects or infrastructure projects that are not going to really pay off, because GDP is measured as an income, as an expenditure level, and it's not really a value level. So basically, to have the growth in GDP become lower next year in China, if the investments are in better projects or not in bad projects, is really increasing wealth and not dissipating wealth per se. So I think the consumption part will continue to grow in China, and even though infrastructure investment will continue to grow and become an important, still an important part of the fiscal policies in China. I'll get back to this in a moment. So I think the third plenum, which was announced today, will, as we said, have a rebalancing agenda, but will be slow and incremental. And obviously, social stability is going to be the real interesting part of any plan that we're going to see in China. But I think it's amazing to me that even though it's not specifically written yet in the plans, but just in a vague sentences, I think the provincial governments and the towns and mayors will be given more autonomy to raise their own money, issue bonds, and in particular, allow for property taxes. There's going to be a change in the value-added tax and how the sharing relates between the central government in China and the provinces, in the sense that after Zhu Rongji in 1993, the cities and towns actually became starved for money, and the central government took a very large fraction of the VAT, over about 75% of the value-added tax, for their expenditures. And as a result, the local governments used land sales, or confiscation, if you want to think about it that way, from the farmers for construction, and financed about 25 to 30% of their expenditures by that method. So I think that we will see, as a result of the current program, that we will allow, there'll be property rights for peasants and an ability to have credit. Sorry about the misspelling of credit. But it'll allow for peasants to be able to have property rights on their farms. And with 700 million people empowered, as well as having an ability for collectives to actually raise money and to finance their activities, this will be a great growth engine in the future, I think, for China. So the central government is going to have more responsibility for education, for pensions and health care. And I think that citizens or persons who move from the country, say, to Shanghai, will have the same rights as other Shanghai citizens for education, pensions and health care, and other social services. So the reform, it's actually interesting to me that that in China itself, that the most important thing is in the next 30 or 40 years that there's going to be a huge movement of people from the country to the cities, and the world is going to change dramatically. In the Western world, we have 4 megacities. That's Paris, London, New York, and Los Angeles. And already in China, we have 7 megacities that'll be in the top 25, which will, in the next 20 to 30 years, will probably have about 14 megacities in China as many more citizens move from the country to the cities. As we saw in the programs released today, that in these 25 years or so ahead, to build these cities, we have to have sustainable cities. So the great growth in infrastructure in China is going to be figuring out ways in which we can have sustainable cities, in the sense they can have sustainable cities in the sense that they're ecological friendly, at the same time as that the scarcity of resources and pollution and the likes are handled. So these are great technological innovations ahead, which are going to be needed to sustain the economy. I think also we're going to see reducing of anti-competitive regulations, and at the same time try to make the state-owned enterprises more competitive. And this will be slow, but it'll become part of the economy. So in my area, which is finance, in economics, we've already seen it, but we're seeing the liberalization of interest rates. Additionally, the convertibility of, more so through the free trade zone in Shanghai, the convertibility of the RMB into other currencies, and also increase in bank competition. Though in the actual reading of the report today, my reading of the report today, it seemed to sustain the government having power over the banks, having power over the power system, electric utility system, and also power over the energy system will be retained. But other parts seem to will be more liberalized and become more competitive. So I think if we look at the stock markets, which have always been a way of looking at recovery, markets tend to be far-sighted in signaling recovery. Earnings in the US, if you think about them, consensus earnings tend to be strong. And if you use consensus earnings and projected price earnings ratio, given the interest rates we have today, that you can estimate about an 1,800 on the S&P 500 in the US, while it's about 770 now. So the market doesn't seem to be that overvalued or undervalued, though some other people say we're at the very high end of the valuation curve, and where are the earnings that are going to be there to sustain this growth that we are incorporating into the estimates. And so I think with austerity in Europe, Europe doesn't have the same growth model as the United States, or in my view, the growth model that China has. I do believe China and the United States are going to be competing in the future head-to-head, while it's the case that Europe really wants stability, not much to change and keep the life that they've had today. So the policies of their governments and the policies of their central bank will be to maintain the status quo as long as we possibly